All right, so up to this point, we've covered, the basics of kind of risk management, and we've looked at insurance, and we've also looked at the purchasing decision from a consumer perspective when it comes to insurance policy. What we haven't dove into just yet is how an insurance company operates. So this will be important for you if you find yourself working for an insurer, if you're dealing with an insurer, or if you're a risk manager and you're thinking, all right, well, maybe for D&O insurance, who are we going to go to? Okay, so this is beneficial not just if you want to work for State Farm or Geico or something like that. Knowing kind of how these entities, these businesses operate, will definitely improve your business acumen in the future. Okay, so operations for insurance companies break down into kind of these primary points here. We will be spending a little more time on certain parts than others. So we'll be focused a little more on rate making, underwriting, and then when it comes to production, we will kind of be a lighter touch on that. But ultimately, this is still just a bird's eye view. Okay, we'll get our feet wet, see how the water feels, and then we'll worry about this later. Especially if you're a risk management major, then of course you'll go into all this at a later date. Okay. All right. So I think the best way to go about this is to start at how we create this underlying product, how we identify the underlying product, and that is with rate making. So rate making refers to the pricing of insurance. This is not the premium per se. This is not the premium just by itself. The rate is not the premium. It's a per unit price, and we ultimately want to price in the risk. So per unit price, and then we have some exposure unit. It could be time. You're exposed over time to automobile accidents. So the rate exposure could be the vehicle that you drive, and then how long the policy lasts. So a vehicle and a year. So those two helps create the premium. So your premium is the rate and the exposure. The risk tied in and how long you're exposed to that risk is another way of thinking about it. What's peculiar about this from an operational standpoint, and this is also for people purchasing an insurance policy, you don't know how much it's going to cost. No clue. No clue whatsoever. Go back to our loss distribution problems. We can create an average. We can create a deviation. But one peculiar thing that we might have noticed in doing that, there are often times where you can compute an average loss, let's say, an expected loss, but it would never actually be a true outcome. Right? We'd have an expected loss of, let's say, $400, but all the outcomes would be lose, $0 or lose $5,000. So we don't know the true cost of these products until, frankly, it's too late. And this is for individuals on kind of both sides of the equation, the firm and the consumer. So it's not just from the pricing side. So that is kind of unique. Okay? There are other products that are like this, but insurance definitely falls under that umbrella. We don't know the true price of it. So there's estimation here. Okay? So who creates rates? Ultimately, this falls on to actuaries. So actuarial science is usually the focus on pricing and then the premium setup. For an insurance policy. This is not to say that this is all actuaries do. That is false. But when it comes to rate making, actuaries are who you want. So they have statistical tools, mathematical tools, econ and finance background. Okay, so highly specialized and highly focused on risk assessment or rate making. So what's the financial risk of this loss? So this will be valuing cash flows, looking at shocks to those cash flows. If we look at life insurance, we have mortality tables to use for that. So it's the study of uncertainty and really uncertain cash flows. So probability and financial mathematics, two components of the test for an actuary, two very important components. And again, not limited just to insurance companies. Now, this is not a testable slide. This is just for your information. So if you are interested in becoming an actuary, I have a link to Ball State's Actuarial Science Certificate. If you have any questions, please let me know. And what follows here, these are not actual requirements. These are some of my suggestions. Some of these are requirements, but these are my suggestions. Okay, you need to be very comfortable, okay, with statistics, math, and then finance and econ. Okay, very comfortable with those. And I put a couple of classes here. I'm not sure if time series is something that's offered just yet. It might not be called time series. These are my suggestions if, again, you're interested in actuarial science. So this is not testable material that'll benefit you if you are curious. All right. Now let's say that we've set these rates. Our actuaries knocked it out of the park. Okay. We know the rates. And let's even say, here's the rates. We know the exposure. We can calculate some, pretty good premiums. But how do we figure out which policies to write and which policies not to? How do we classify and select? Well, that's underwriting. So the classification of the risk falls to the underwriting team. Most firms will have a statement of underwriting policy that details, the risks that they do want to take on, they don't want to take on, and anything in between. And usually within their objectives, ideally you want to make an underwriting profit, but we know that doesn't always happen. So underwriting is not the only source of profit for an insurance company. You know that they have investments as well, and that's something we'll cover at the end of this chapter. So again, some of these basic goals and objectives, I mentioned the first one already. You'd like to make money. Okay, if you take in $1 million of premiums, you hope that you don't pay out much more than that. Ideally, you would pay out less than that. Select policyholders based on what the firm is comfortable with underwriting. Maybe they don't want to write flood and windstorm policies in Florida. Something we need to be aware of. This last point here is really an artifact, or would be an artifact if we correctly mitigate adverse selection. So providing equity among the policyholders would be an artifact of mitigating or reducing adverse selection. Meaning that if we make sure those high-risk individuals don't get those average or low-risk policies, in this case, the premiums that are lower than what they should be paying, we classify them correctly, it's fair for the people or businesses who do fit into the average or low-risk policy. Essentially, we don't want to charge a bad risk like it's good risk, because then the good risks lose out. We can have that downward spiral again. Okay, so this equity here is not, we're not talking about stock offerings or equity like that. This is just fairness. So we're charging a low risk like we would a low risk. Average like we would average, and high risk, we're charging them a bit more. Now, what are the steps? Now, in most ways, the agent is kind of the first or field underwriter. Could be a straightforward kind of application process. Wouldn't be many site visits, depending on the agent. Wouldn't be many site visits. So that's kind of the first line of defense. Now, where can we gather some of this, underwriting information? So this relevant fact finding is what we'd like to do. For some, it begins and ends in applications. Renters, sometimes homeowners policies and personal auto policies, the application is good enough. The actuaries know that certain things factor in and maybe describe 90, 95%, or 99% of someone's risk factor. The application tells us that. Anything else, going for the extra 1% at the margins might cost us more than it saves. Beyond that, agents can do reports. We'd have inspection reports on the risk. If it's a physical building, as opposed to, I'm not sure of any other types of buildings, but if it's a building, it physically exists. So we get a physical inspection. This could be through a third party. If you have health insurance policy or you want a life insurance policy, it's not uncommon to get a physical exam. Now the agent's not going to be doing that. If they do, you need to go somewhere else. But it could be that you have to go to your primary care physician for just a standard checkup, along with questionnaires in the standard application. And ultimately, once we've done all this, the answer to that potential policyholder is yes, no, maybe so. We accept outright. If it doesn't meet our objectives, we'll just say no. It's a risk that the company doesn't want to take on. We say no. If it's somewhere in between, then maybe we have to augment the policy. Maybe the building looks okay and mostly up to code, but we think there's a higher fire hazard. So either we'll raise the premium or say, hey, look, all is well and good, but we need you to put sprinklers in. To get this premium, you need to put sprinklers in. And that would then be part of the contract. Now, computerized underwriting in this, we would have something that she'll model. We put in a couple of factors about that risk. And maybe that building, when it was built, how high is the water table there? How likely is it to flood? Does it have sprinklers? And with that, we have this kind of predictive method. Computerized underwriting also covers online applications too. It's underwriting essentially, and you're using a computer of some sort. All right, so let's say we've got our rate set. We know a good bit about what we want to do from the underwriting perspective, the businesses that we'll take on, the individuals we'll take on for our policies. How do we get that knowledge out there? It's not often that people just come looking for something like life insurance, for example. That refers to the production. Now we'll keep this simple for now, but this is very much kind of in the marketing sphere of things. So production is just sales and marketing for insurance companies here, right? Because as a financial product, you're not sitting there on an assembly line, not physically. We are going through an assembly line of sorts, but it's not a physical product, not a widget we like to call it in accounting that we're producing. It's a financial product. It's a service. Agents are often what we call our producers, salesmen and women there. And this marketing also tends to represent a pretty good chunk of expenditures for most insurance companies, which shouldn't surprise you. You could probably name a couple of commercials. Commercials are not generally very cheap to produce. So that's kind of all in production. We'll keep that a little bit short. All right. Now let's say, at the rates, we've underwritten to the best of our abilities, we've sold, marketed just well, Unfortunately, we're going to have claims, right? It's rare to have a pool of insureds and to not have any losses. Maybe in a day, sure. But for entire policy period sets, it's rare that you won't have claims. So the basic idea between, it's not meant to be combative. The basic idea here is we want to make sure that the money that's being paid is what should be paid, what is duly owed to the policyholder, no more, no less. In doing so, there are a few steps. First, we want to make sure that it's a verified loss. It's something that we do cover. We don't want to just go giving money to everyone because they suffer a loss. No, they pay to cover a particular loss. If it falls within that umbrella, it's covered. Once we know it's covered, get the money to them in a fair and prompt way. This is set at the state level. But fair and prompt usually means less than 30 days. Again, varies. And then there are those kind of assistances offered to the insured that are on the periphery, or they're more ancillary, they're more supporting, rather. So if you get into an accident, well, excuse me, you won't get into an accident. Never your fault. Someone else hits your car. Their fault. Not paying attention. But it damages your car. Say you have State Farm, they'll get you a rental car. That's part of it. Now, if you're driving let's say a moped that happened, they're not going to get you, a Lexus. It's going to be comparable. If you're driving a Lexus, you might get something comparable for the interim. Driving a car, you're probably going to be able to get an SUV to replace, because it's more expensive. But something comparable. Think back to indemnification. Not above your original position, just at maybe slightly below with deductibles and the time value of money. There are certain claims that we prohibit by law. We're going to cover that in the next chapter, chapter 8. We'll go through a few of those with sales and claims. Okay. All right. Now, we have the claim. How much do we pay? This is on the adjusting side. So look at the cost there. We could have an in-house adjuster. So an agent, we would, could be an in-house adjuster. Agent works for the insurance company. You have our company adjuster. That's a little more common. It's rare for the agent to be the adjuster, especially if we go back to personal auto policies. It's not common that the agent would also be the adjuster. We can hire an independent adjuster. And then if there's a bit of friction between policyholder and insured about the payout, there are public adjusters that are supposed to be a third party, unbiased, to estimate the cost of these losses. Now, that's not always what public adjusters are for. We often see these in windstorm and flood losses as well. A public adjuster will go and assess the damage. Okay. So it's not always that there's some contention between the consumer and the producer here, the insurance company and the insured. It's not always the case for a public adjuster. Now, when it comes to some of those steps, the policyholder has to let the insurance company know that there's a loss. No firm should go looking for expenses. And when I mean looking for expenses, I don't mean looking for a tax write-off here and there on things that you're going to pay. No, that's fine. But looking for actual expenses. Trying to create expenses, because that's what this would be. So the burden's not on the insurance company to call in and check on their clients to see if they've had a loss. That onus is on the client. Investigate the claim. We went through that. There's some adjustment. We want to make sure that it's verified. Proof of loss. This can be easy. Police report if it's personal auto policy. If it's an independent adjuster, then they're going to write that out. Not the police report, but they'll write out an inspection report. For health insurance, usually pretty easy. Doctor's bill. And then this is when the kind of ex post adjustment can come into play as well. Okay. So pretty straightforward on that, though the devil's always in the details. All right, so what we've done now is we've covered what I will call the front line of an insurance company. Creating the product, getting the product out, upholding our end of the bargain, paying those claims we're supposed to pay, providing any kind of ancillary services, assistance to the insured. We've done all that. So we've kind of covered all the way up to what would be within our underwriting profit. But there are some things that are going on, I don't say behind the curtains, that seems a little too sinister, okay? But on kind of the back end, on the financing side. So there are other things going on that aren't completely related to the product itself, that policy itself. One of them is reinsurance. A very simple explanation of reinsurance: it's insurance for an insurance company. An insurer writes these policies and then wants to move or cede the risk of those policies to another insurance company or a reinsurer. That is the gist of reinsurance. Now, it could be that they have I write the policies, I'm the insurance company that initially writes them. It could be that I'm kind of up to capacity. Maybe it looks like some of these policies are a little bit riskier, so I'd rather pay a premium, so a known expense, than an unknown payout for what these policies could be, right? We've measured deviation for very small risk pools, and we see that it can vary quite a bit. Now imagine you have a very large risk pool, as opposed to a deviation of $2,000, it could be $2 or $3 million. So the firm might prefer to pay a premium, a set premium, to insure their insured policies. A little bit of terminology here, that just so that I'll be using this in the next few slides. The ceding company, that's the primary insurer. So an example, I'm the one that writes the policies, and then I want to use reinsurance. I am the ceding company. I am the one who initially writes the policy. Whoever takes on, so we cede it, whoever assumes the risk, they would be a reinsurer. And it could be, and generally speaking, they call themselves a reinsurer. That's what they focus on, their specialty. So Apex Re, Geneva Re, Franklin Re, those are all reinsurers. A retention limit will be the amount attributed to the policies that I keep. I'm the ceding company. I'll keep some of those policies. And what I mean by keep is I will pay for the risk, the losses. So what's not happening here is I'm not just saying to my policyholders, hey, I'm no longer your insurer. That's not what's happening. I'm still their insurer. I'm just transferring the risk of those policies. So I'll say, hey, reinsurer, if my losses on this line go above $1 million, I want you to pay anything above that. That $1 million, therefore, my retention limit. The cession is whatever value we attribute to those policies that I cede. So if they'll cover from 1 million up to, let's say, 5. So they're covering 4 million of total losses. That's the cession amount. In very simple terms. If the reinsurer then moves some of that risk to another reinsurer, then that's a retrocession. All right. So again, what's happening here is if I'm the primary or the ceding company, I'm not giving those policies. I keep the policies. They are still my insureds, either individuals or companies. And I still am obligated to pay what I owe them. In fact, I'm obligated first and foremost. So there could be a time lag between when the reinsurer pays me. Traditionally, it's not too much. It's not a problem in the market, but there could be a small time lag. Because I have to make those fair and prompt payments. But I'm a big company, I don't have the same protection that individuals do. So it may not be the reinsurers are beholden to the same stringent requirements of fair and prompt payments. Again, not usually a problem in the market, but just something to think about. Now, how does this work? So it actually is quite complicated, or can be quite complicated. What I want to do today, since again, we're just getting that bird's eye view, go through some of the simple methods that we'll see reinsurance be utilized. So from here to the next 5 or 10 minutes, we're talking about two completely separate firms. They don't have businesses, they're not under the same conglomerate structure, so it's external reinsurance. It's coming from outside. Okay, so this is all external reinsurance. Right? Now, why would they want to do this? And this is for external. Increase that capacity. Once I see the risk of some of those policies, I'm just paying a known expense. There's not an uncertainty tied to that expense. I agree to pay that premium to the reinsurer. It's an expense now rather than being tied up in loss reserves or unearned premiums. Well, we still have that, but there's less certainty. Therefore, it could also stabilize my profits. I know that on that line of insurance, I'm only to lose up to $1 million, nothing more, nothing less. Mentioned the unearned premium reserve already, lowers my liability, and could provide protection against a catastrophic loss. So reinsurance is often heavily utilized in those markets where we see catastrophic risk. And a quick reminder, so catastrophic here, insurance terminology, what we mean is that all the exposure units are highly correlated. It just so happens that something like a hurricane is a catastrophic event in both definitions of the word. What we mean here is that the losses are highly correlated. One happens, they all kind of happen. So keep that in mind, what we mean by catastrophic here, highly correlated. Because you try to pool a bunch of highly correlated risk, if it's perfectly positively correlated, one suffers a loss, they all suffer a loss. There's no real uncertainty there. That's detrimental to the pool. Okay? We don't get the pooling advantage if the correlation is perfectly positive. Now, the very brief kind of overview here, we're going to go through quota share treaty and excess of loss. A reinsurance pool is just a number of reinsurers getting together with cessions and retrocessions. Okay, we won't work through an example of that, but I do want to have it listed here. So a quota share treaty is kind of like profit and loss sharing. So a reinsurer will agree if they receive a certain percentage of the premium value, they'll cover that same percentage in losses. So an example here, Apex Fire Insurance and Geneva Re enter into a quota share treaty at 50-50. They both get 50% of the premiums, they pay half the losses each. So if a $100,000 loss occurs, Apex still has to pay. These are Apex's policyholders. Apex still has to pay. Apex pays their policyholders, and they're reimbursed ex post, usually, by Geneva Re. Geneva may also charge a premium on top of that. So not only do they want half the premiums, they might want another 1 to 2% on top of that. They're still taking on some risk. There could be some commission, ceding commission here. Now, excess of loss reinsurance is the example that I gave you earlier. We'll pay up to $1 million. Anything above that, another firm covers it. The example we have here, let's take Apex Fire again, and they want to have an excess of loss reinsurance. They couldn't get it through Geneva, so they go to Franklin. Franklin says, all right, we'll pay for all your losses above $1 million, only to a maximum of your losses at $10 million. So they expect to pay no more than $9 million total. So that's kind of the optics. Those are the optics here. So the total that they would pay is $9 million. If there is a $5 million loss, Apex pays the full $5 million to their policyholders. Franklin pays Apex $4 million. If there's an $11 million loss, Apex pays the $11 million to their policyholders. Franklin only reimburses them the $9 million. So Apex's total payout here would have been $2 million. It could be that they get a reinsurance policy from 10 to 20 million from Geneva Re. That's an option as well. So this is all external reinsurance. External. These firms, we assume they're not related in any way, shape, or form. They're not owned by the same parent company. However, it's not uncommon to see internal reinsurance being utilized. So this would be like two insurers that are owned by the same parent company, utilizing the same policies, the same methods that we just seen. It's quite common in the U.S. for property casualty insurers. Billions and billions of reinsurance premiums. All internal. So from the parent's standpoint, so we call this headquarters, they're at the top of the chain for the conglomerate structure, so the parent company. Nothing's really changing for them directly. You're moving capital or capacity from one firm to the next. Okay, so you do have these internal capital markets that exist here. What do these groups often look like? They're not always just insurers. Quick little example here that you will not have to recreate. But it's not always insurers. We have a couple over here. Now they operate out of Quebec here, but they also have U.S. operations. So it can be quite complex. Let's say that Optum Farm Insurance here and Optum Nest Insurance want to utilize internal reinsurance. Changes nothing for the parent company really. It's contractual. So why would we do it? The parent company doesn't really increase their capacity. So there are slightly different reasons that we would see internal reinsurance be utilized. Okay? It could be that it's an avenue to invest in quantum farm insurance here. Maybe they're kind of at capacity because there are regulations, capital regulations. They're at capacity, but they know that in this market there are some opportunities. So what they do is they enter into a reinsurance contract with one of their sister or brother, one of their sibling firms that increases their capacity, then they can go and write those policies. From the parent's perspective, headquarters, the top, they might see that and say, all right, well, this insurer is not at capacity, but they don't really have anything to write. There's no market for them right now. They're doing well, but there's just nothing that fits in our underwriting policy that we want to write. But the farm insurance side, maybe they have some opportunities, but they're at capacity. Switch that around, boom. Ideally, it's a positive NPV project for the parent company and the farm insurance subsidiary. And hopefully would not hurt the others. You're still increasing your leverage. You took on some risk. But you could still get a ceding commission. And the farm insurers could still write policies and make money on that too. So it's an internal capital growth. It could also be, there's evidence to suggest, that it's to make another firm kind of not appear, but make them stronger. So let's say that instead, it was a bad year for farming, which happens. And even with government subsidies that we get, so there's a lot of subsidization for farm insurance, crop insurance. Even with that, this firm didn't do well writing their policy. It was just a bad year. It wasn't necessarily their fault. It wasn't the farmer's fault. It was bad weather. Okay. So right now, they were already kind of leveraged. And then their losses were higher than they expected. They're not in a very good capital position. And we know that S&P, Moody's, AM Best, we know that their ratings matter to most of our customers, especially our big customers. And they might say, well, this farm insurance right now, we're going to rate them at a B. And then the other insurer is at an A. Well, what if we can move that capacity and have 2 B pluses or 2 A minuses? That might be better for us at the group level than having, that A and a B or an A and a C. So it could be that we're moving it to improve the leveraged capital position so that we are stronger and look stronger. The parent company doesn't really matter, but you could argue that's a good use of internal capital. It might seem weird at first because, well, these guys are doing poorly. Why are you going to reward them? Reward them with this capital. But from the group structure, from the top looking down, it can make sense. All right, so this is not and also these are not the only two reasons. In fact, the other slide about wanting to use external reinsurance could also work too. Okay, but from the group structure of the parent company, it's not always the same because you're not really increasing your total capacity. You're moving it around across subsidiaries. Okay. Now, what are some alternatives to reinsurance? Cat bonds. We've covered those. Right? We know about those. There are arguments that in the mid to late 90s, there was too much adverse selection in reinsurance markets. It was all for cat risk. It was like, what, we'll make, at that time they were called insurance-linked securities. We know them now, or a portion of them now, we know them as cat bonds. We can raise capital that way. We don't have to increase our position using reinsurance. We'll issue corporate debt. And other insurance-linked securities have sidecars. It's kind of like more for life insurers. And then your online assignment for this week is the Aetna video that's linked here. You may see a question about that in the exam. So the Aetna cat bond. I think I did mention in class when we were discussing cat bonds. Because traditionally cat bonds we see for property casualty. We don't see health insurers offering cat bonds. Pretty interesting take on it. And this was 2019, okay, so it's a year ago. It was the first health insurer to offer a cat bond. And I think the last, I haven't heard of any this year. The last so far. Okay, what about investments? So here, what I really want to do is I want us to tease out the difference between life and health and then property and casualty. So have kind of life and health juxtaposed with property and casualty. Okay. So life insurance investments tend to be, we see it here, longer term. So another way to think about it, a longer term is not quite as safe as a shorter or liquid investment. I'm not saying they're unsafe. They're not quite as safe. So life insurance investments tend to be a little more risky. Again, we're really at the margins here, but a little more risky than property casualty insurance. Now, the reason for this, so this is more important in my mind, the reason is chiefly due to the underlying volatility of these products. Life insurance, we have mortality tables that help us with life and annuity contracts. Those are far more accurate, relatively speaking, they're far more accurate than predicting how frequently we're going to utilize director and officer insurance. So because the underlying risk of life insurance products is lower, they can have longer term investments. We can say riskier, but I don't want you to think that life insurers are investing in risky assets. But they might be more inclined. Life insurers hold slightly more real estate. Property and casualty insurers do not hold a lot of real estate. Those are longer term, and they can be more risky. When the market tanks real estate, it can tank pretty hard. And another reason that life insurance products are a little more known, a little more certain, is because a lot of the life policies have a set payout value. If you get a $500,000 life insurance policy, I don't have to guess how much I'm going to pay you out. I only have to know when you're going to pass away. Doesn't usually happen with property casualty. Yeah, I can set upper limits, right? I can set an upper limit. Your personal auto policy might have $100,000 or $300,000 liability limit, perhaps. All right. So again, reiterate, because life insurance contracts themselves are not quite as volatile, they can be tied up for a longer time in their investments. We could say they're slightly riskier, but again, these are often very sound investments. Okay. All right. Questions about Chapter 6? Yes.
Okay, so I know that like this topic isn't like a major topic, but when we were talking about like proof of like you need to prove.
Verifying losses.
Yeah. Okay. So what about medical? What about HIPAA? Because you can't release medical claims like doctor bills. You can't release that because like that's what I did, and we were only able to send a payment summary that said that they paid, like this is how much that they want in UMBI.
Yes.
So like, how would that hold up if we can't send medical, like if we can't send the actual doctor bill?
So there's usually a code, and you have medical codes. So the question is, what about for health insurance, and does HIPAA make it so I can't really verify a loss? So usually when you go see a care provider of any sort, there are medical codes for each thing that's charged. Then they'll input those medical codes, okay? And the insurer has certain prices or what they will cover for those codes, and then based on your deductible or your co-insurance, you pay the remaining fee.
Yeah.
So it would not require
an actual like medical.
Not at all. It would
Okay.
be code. It would be code related. So
Okay.
if I were on the end of claims processing, yeah, I might know what certain codes are. But more than likely, I'm not diving into your very specific medical.
Okay, because like when we would get it, because we did car accidents,
Mm-hmm.
we would get like the actual doctor bill that said like they got like a CT scan or an X-ray or everything like that, and what they were actually like, what they were treated for, and like what that was. Like I was allowed to see that, but I wasn't allowed to release that information to like any type of person.
Yes. So usually if you go to an urgent care, you go to a doctor, you're going to sign certain release forms.
Yeah.
And usually it's just your doctor and or your insurance company that you may or may not use.
Okay.
So pay attention to the fine details there if you are worried about it. That being said, if you say no, you probably won't get care.
Yeah. I just didn't know because like, I mean, as a third party, like we worked on behalf of insurance companies, so they would send us everything that they had in their file, but we weren't allowed to share that. Like even if it was like we called it the double list, so it was State Farm versus State Farm,
Mm-hmm.
we weren't even allowed to send that in a packet to State Farm.
Mm-hmm.
So like I was just like confused on how that would work against a claim.
Usually it comes down to the bill amount.
Yeah.
Right? And the code attributed to that. Now again, you can look at the code, but it usually comes to the bill amount, and that's often why the prices are agreed on beforehand for certain services.
Okay.
It could be that they don't agree to cover that service. It could be it's out of network, right? So it does kind of get a little fuzzy. And one of the things that we see oftentimes people complain about health insurance or health care in general, because those are not the same thing, but they are heavily involved. People say, well, why are there so many hands in the pot? Sometimes it's almost necessary if you value some privacy, right? I'm not saying it's all necessary. We're welcome to all have our opinions on healthcare, health insurance, right? But the reason it seems, and by some arguments, you could say it's quite convoluted, sometimes there's a necessity there. Because if I'm protected by HIPAA, for all information, I go see my doctor, and he or she's like, you totally need this, but maybe you don't, and we'll just split the amount. I'm not saying a doctor would do that, but a human being would, and doctors are human beings, right? So we do have to know that what we're paying for is what we should be paying for. If we keep everything behind a thin veil, or even behind, not cloak and dagger type, but behind the veil, it's more difficult. It creates that kind of fog, and it could be that we're paying for things that we're not supposed to.
Yeah.
Yeah, and it's a little more difficult for health insurance,
Yeah.
for sure. But it relies mostly on the codes, and again, mostly on the itemized bill.
Okay.
Great question. Any other questions about chapter 6? Okay, well, let me stop the recording here for our friends watching on YouTube. And we'll